Here's the truth. Most Americans have no idea how vulnerable their retirement really is, and it's not because they're bad at saving, it's because the system has trained them to feel safe while quietly eroding their security every single day. Imagine this. Your 401k is your lifeline. The stock market has been good to you, and yet you wake up one morning at 65, ready to live the life you've been planning for decades, only to find that inflation has eaten through your purchasing power faster than your dividends grow. Interest rates on your bonds barely cover your cost of living, and suddenly that feeling of security you built for decades feels like a fragile illusion. Most Americans don't realize that holding too little cash in retirement is just as dangerous as holding too much, because too little liquidity leaves you at the mercy of market crashes, unexpected medical bills, or a sudden spike in living costs, while too much cash sits idle, quietly losing value to inflation every year, compounding regret instead of returns. Let me be clear, this is where people get trapped. They see their investment statements and think wealth equals freedom. But freedom in retirement is about control over your options, your time, your ability to respond to emergencies without panic. And too often people discover that all those years of investing for growth left them exposed when they needed stability the most. Picture this, it's 2027. Inflation has risen to 6% annually. Your $500,000 nest egg feels like it should cover your lifestyle, but your annual withdrawals combined with taxes and rising costs are quietly shaving $30,000 off the effective value of your cash every year. Most Americans haven't thought through scenarios like this, and they're stunned when their retirement isn't just delayed, it's compromised. Here's another truth. People underestimate sequence of returns risk. That's the brutal reality where the order of gains and losses in your portfolio has a disproportionate effect on your financial security, and when you withdraw cash during downturns, your portfolio might never recover to its prior value. Let me illustrate. You retire at 65, the market drops 30% in your first 2 years, you continue withdrawals of $40,000 per year to cover living expenses, and suddenly that comfortable $500,000 cushion becomes a $350,000 panic scenario. It's not fear-mongering, it's math, and it's relentless. Now imagine a friend telling you, just keep investing, don't worry about cash, and while they mean well, they're ignoring the reality that liquidity, cash on hand, is not just money, it's optionality. It's your ability to act without stress, to make choices that preserve your lifestyle and independence when the world refuses to wait. Most retirees fail because they confuse investment growth with financial freedom, not realizing that without enough accessible cash, a single hospital visit, car replacement, or home repair can cascade into debt, stress, and even forced asset sales at the worst possible moment. And yet, holding too much cash is also a silent killer. Every year, that $100,000 sitting in a low-yield savings account loses purchasing power to inflation, quietly eroding decades of careful work while leaving you numb to the true cost of safety. Let me be clear, this isn't about avoiding risk entirely. It's about calculated control, about creating a buffer that allows you to sleep at night while still participating in growth. Most Americans don't realize that the right balance of cash, bonds, and equities isn't a static number. It changes with market conditions, personal expenses, health, and the flexibility you require in retirement. Here's another harsh truth. Advisors often recommend a 3-6-month emergency fund for the working population, but that advice dies the moment you stop working. When income stops, your monthly expenses dictate your cash needs, and for retirees, a single unexpected cost can spiral into a multi-year problem if cash reserves are insufficient. Visualize it. Your air conditioning dies in the dead of summer. Your car transmission fails, a minor surgery ends up costing $15,000 out of pocket, and suddenly, without a solid cash buffer, you're forced to liquidate equities at a 20% loss to cover expenses. It's not hypothetical. These are the stories I hear every day. People who thought diversification alone was a safety net, only to discover that liquidity, or the lack of it, was the real risk. And here's the kicker. Holding too much cash might feel safe, but it creates hidden opportunity costs. That $200,000 in a savings account could have been working in a diversified income-producing portfolio, generating $10,000 a year, compounding over 20 years, rather than quietly being diminished by inflation and the eroding power of lost opportunity. This is where people get trapped. Comfort becomes complacency, and complacency becomes regret. So how much cash is enough? Let me be clear, there's no one-size-fits-all number, but you need to think strategically, not emotionally. Factor in fixed expenses, discretionary spending, healthcare costs, potential long-term care, tax implications, and your risk tolerance. Many retirees underestimate healthcare. Medicare only covers so much, and supplemental insurance plus out-of-pocket expenses can easily add $5,000, $10,000 per year per individual. Car replacements, home repairs, property taxes, these aren't emergencies, they're inevitabilities. And yet many Americans enter retirement assuming they can just sell investments if needed, ignoring sequence of returns risk, market volatility, and capital gains taxes that can diminish the proceeds. Now picture the alternative scenario. You retire with a well-calculated cash buffer that covers 1-3 years of essential living expenses. You don't panic during market dips, you don't make rash withdrawals, you can weather recessions, medical emergencies, and inflation spikes. You sleep at night knowing your lifestyle is intact, your investments can remain invested, compounding quietly, while your cash cushion absorbs shocks. Here's the reality. Most Americans don't visualize this. They underestimate the psychological relief of knowing you can pay for a major expense without touching volatile investments. That feeling alone is worth tens of thousands of dollars, not in financial terms, but in peace of mind, health, and quality of life. Let me be clear, cash is power, but only when allocated intelligently. Too little leaves you exposed, too much leaves you stagnant, and most people sit somewhere in the middle, pretending they're safe while quietly being destroyed by inflation, market cycles, and unforeseen costs. And this is where the hard self-reflection comes in. If you're 60 and counting on a retirement plan that assumes perfect markets, zero emergencies, and consistent returns, you're already behind. Every month you delay evaluating your cash needs, every year you avoid stress testing your financial assumptions, compounds risk silently and invisibly. The problem isn't just numbers, it's psychology. Most Americans don't realize that fear of underestimating cash leads them to hoard, while fear of missing out on growth leads them to underhold, and the tug-of-war creates paralysis until a crisis forces action. And crises are inevitable. The question isn't if your portfolio will be tested, it's when, and the difference between panic and control comes down to preparation, liquidity, and honest self-assessment. So here's the challenge. Look at your cash today. Calculate the realistic costs for the next 2-3 years, stress test for medical emergencies, inflation, and market crashes, and then ask yourself, am I prepared, or am I gambling with my independence and peace of mind? Because here's the final truth for part 1. If you get this wrong, there is no rewind, no second chance. You either step into retirement with clarity, control, and confidence, or you will face the slow, silent erosion of your wealth and dignity. And most Americans only realize it after it's too late. And just as you think you've understood the math, the irony hits. The very market you relied on for growth can betray you in the first 5 years of retirement, and without enough cash, your choices evaporate. That's why part 2 isn't just about numbers. It's about mindset, identity, and the blueprint to survive and thrive no matter what the markets do. Because the real question isn't how much cash is enough, it's will you be ready when the world forces the answer? Now listen carefully, because part 2 isn't about numbers anymore. It's about your financial identity, your habits, and the mindset that will determine whether you survive retirement or merely exist paycheck to paycheck, watching your savings shrink and your independence slip away. Let me be clear, most Americans have never faced the brutal reality of what happens when market volatility, inflation, and life's unpredictable emergencies collide. And the reason isn't luck, it's mindset, preparation, and discipline. Or more accurately, the lack of them. Picture yourself at 67, 3 years into retirement. The market just experienced a 25% correction. Your portfolio is down. Inflation has silently eroded 10% of your purchasing power in those same years, and you suddenly realize that the cash cushion you thought was sufficient barely covers your essentials. $30,000 in withdrawals turns into $50,000 after adjusting for medical emergencies and unexpected home repairs, and every decision feels like a forced choice, a compromise, a blow to the independence you spent decades earning. Here's the truth: the numbers alone won't save you. What saves you is clarity, proactive planning, and an identity shift from reactive retiree to intentional architect of your financial life. Start by reframing cash, not as idle money, but as strategic control. Freedom to act without fear and leverage against the unseen forces that threaten your lifestyle. Most Americans underestimate how much peace of mind that simple mental reframe can provide, and yet it's the difference between withdrawing $10,000 in panic during a downturn and calmly living off a pre-calculated, well-allocated reserve while your investments recover. Let me illustrate. Imagine having 3 years of essential expenses in cash, safely allocated across high-yield savings, short-term treasuries, and liquid bonds, while the rest of your portfolio remains invested in growth-oriented assets. Market dips no longer dictate your quality of life, medical emergencies no longer force rushed decisions, and inflation, even if brutal, affects you gradually rather than catastrophically. But to get there, you need more than spreadsheets. You need self-discipline, a daily review of expenses, a deep understanding of your own psychological triggers, and the humility to adjust when assumptions fail. Most retirees fail because they overestimate their own ability to endure financial stress and underestimate the subtle but relentless erosion of cash flow, lifestyle creep, and sequence of returns risk. Now imagine a simple mental exercise. Each month, visualize the worst-case scenario, a recession, a market correction, a major repair, medical cost, and then map out exactly how you would respond without panicking. This isn't pessimism, it's intentional preparation. It's the kind of mental rehearsal that keeps you calm, decisive, and in control when the unexpected hits. Here's another harsh reality. If you ignore this, your cash will become invisible. It will feel like wealth, but in reality, it's an anchor weighing you down, leaving you trapped between fear of loss and the inertia of inaction. And pride plays a role too. Too often people overestimate their own financial savvy or the reliability of the system, assuming Social Security, pensions, or even investments will magically cover gaps. Let me be clear, those systems are designed for survival, not freedom, and assuming otherwise is the fastest path to regret. So what does intentional preparation look like? First, quantify your essential expenses with brutal honesty. Rent or mortgage, insurance, utilities, food, transportation, healthcare, and add a realistic buffer for emergencies. Second, stress test your portfolio against market downturns, inflation scenarios, and withdrawals for unexpected costs, and calculate exactly how much cash you need to confidently navigate the next 3 years without compromising your lifestyle. Third, structure your investments in tiers. Cash for immediate needs, short-term income-producing assets for medium-term flexibility, and long-term growth assets to preserve purchasing power and fund discretionary spending. Fourth, commit to a monthly review not just for numbers but for behavior. Are you spending in alignment with your retirement goals? Are you panicking or acting intentionally? Are your assumptions realistic? And most importantly, cultivate the identity of a disciplined, aware, and proactive retiree. Someone who doesn't react to the market, inflation, or emergencies with fear, but with calculated, calm, confident action. This is where transformation happens. Because here's the brutal truth. Cash isn't just money, it's a psychological shield, a decision-making weapon, a hedge against the chaos of the real world, and most Americans treat it like a passive asset. Shift that mindset and suddenly every dollar in your reserve isn't lost potential. It's active, dynamic security that empowers every choice you make. And let me be honest, this is uncomfortable. It forces self-reflection, exposes avoidance, and highlights years of underplanning, overspending, and reliance on assumptions that never materialized. But discomfort is the doorway to mastery, and financial mastery in retirement is nothing without clarity, discipline, and intentional action. Visualize yourself 10 years from now. The economy has changed, markets have corrected, inflation has risen, but your portfolio continues to grow, your cash reserves absorb shocks, and your lifestyle remains intact. Not by luck, not by chance, but by deliberate planning, by stepping into a new identity where you control your resources rather than being controlled by circumstances. Now, let's talk about compounding, not just of investments, but of behavior. Every intentional decision every month of maintaining liquidity, every disciplined choice to balance risk and safety compounds into resilience, confidence, and freedom. Contrast that with a retiree who ignored these principles. Every unplanned withdrawal, every panic sale, every month spent underestimating expenses, compounds regret, stress, and lost opportunity. The gap between these two retirees isn't just financial, it's emotional, mental, and lifestyle defining. And here's the final push, the moment that separates intention from inaction. If you do nothing, your retirement will quietly erode, your options will narrow, and you will realize too late that the comfort you assumed was security was an illusion. But if you act, if you quantify, stress test, allocate, and adopt the identity of a disciplined, aware, proactive retiree, you step into a reality where you are unshakable, where cash isn't fear, it's freedom, and where your life in retirement is governed by choices, not chance. This is heavy, it's personal, and it's unavoidable. And now as you reflect, ask yourself, will you be the retiree who reacts, panics, and loses control, or the one who commands the system, anticipates the unknown, and lives on your terms? Because the moment of decision is now, the blueprint is clear, and your financial identity is waiting to be claimed. The difference between fear and confidence, chaos and control, regret and pride is entirely in your hands, and it starts with how you view and hold cash in your retirement today.